Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Chinese stocks rally after a volatile session as the Ministry of Finance's weekend briefing hinted at greater government borrowing but fell short of giving a headline dollar figure. European futures are higher. Markets expect a rate cut from the ECB this week after the S&P hit another fresh high and JPMorgan strikes an upbeat tone for the first of the big bank earnings. UK Prime Minister Keir Starmer will pitch his vision for Britain to executives later today at the International Investment Summit in London. We'll be speaking exclusively with the Prime Minister later today.
In the meantime, a quick check on these markets. A cautious start to futures trading. You are seeing red on the screen, slight defensive tilt. However, it's basically flat when you look at the futures story. Eurostoxx 50 futures flat. FTSE 100 down by 0.1%. Not seeing a ton of movement. Even in the currency space, euro dollar 109.28. Cable at 130.66. Countdown to the opening trade starts right now.
Monday morning, good morning. Here's the recap. China still has a deflation problem and is struggling to deal with it. America might have an inflation problem, but it doesn't have a growth problem. See JPMorgan and Wells Fargo, their numbers Friday. Europe does have a growth problem and is definitely struggling to deal with it. Over to you, Keir Starmer. Over to you, Christine LaGarde. Anna, let's start with China, though.
Absolutely. Let's start with China. A lot to recap because this has come in waves through the weekend. You mentioned the disappointing inflation story, and that's been part of the narrative. But that was accompanied by a really high-profile briefing from the Ministry of Finance. We talked about that, the run-up to it, the excitement, the build-up. And they did flag a room for more of a deficit and all kinds of help for local governments, but there was no dollar amount attached. But then fast forward to this morning, stocks under pressure, negativity evident. Then we get another briefing. And then stocks start to rally a little bit, and there's lots of talk of whether the home team got involved. I mean, there do seem to be a lot of moving parts when it comes to China right now.
It's fascinating, though, because the investor standpoint is that, well, actually, this may not help very much. The Goldman standpoint is they actually upgraded their forecast, saying that this is actually a positive. And it's interesting that you're seeing two different takes on what's expected to be a fairly large piece of stimulus. The growth, of course, is still the concern.
Goldman Sachs haven't quite got themselves back to 5%, though,
right.
And that is the target. So we've come up towards 5%. We're at 4.9% on their estimates. You would have thought that China would want to, if it needs to get itself out of a deflationary trap, need to produce some stellar growth here. Does it need to be not 5%? Does it need to be 6%? Does it need to be 7%? How could they get to those kinds of numbers? Because that would be the real game changer. This still feels like a really piecemeal approach.
Yeah, absolutely. Is this still a false dawn, or is this going to turn itself into, or be turned into, a powerful sea change, in the words of Garfield Reynolds on the Markets Live blog? We have, guess what, another meeting coming up at the end of October. So there's always another opportunity to wait for something more on the fiscal front when it comes to China. We'll do that. Kriti, should we talk about what's going on the wider earnings story and the things that were moving around in markets on Friday that resulted in a new all-time high?
Yeah, a lot of anticipation going into the stuff on China as well. But the U.S. story is really feeding into the bottom lines of the banks. JPMorgan coming in, they had a lot of caution going into those earnings, a lot of questions around what lower interest rates might mean for their bottom line. They impressed. They outperformed. They said their net interest income is actually growing. Volume is still growing. These are all signs of a healthy economy that's showing up. However, on the other flip side of it, you're also getting Boeing, for example, talking about a 10% staff cut. Those are idiosyncratic problems. I think the tailwind, or I think the connecting factor here is that these are two major companies telling two very different stories and both trying to navigate a fairly tough environment.
Boeing's really interesting, potentially facing a downgrade. It would be the biggest fallen angel that we've ever seen in America, i.e. coming out of IG into junk status effectively. Watch out for that one. Kelly Ortberg, who's come out of Collins, has now got a major problem. How does he deal with this strike? How does he get this company moving again? He needs the cash flow that comes from deliveries. Many people are surprised that he's letting this strike drag on as long as he is, and to come out as well and talk about cuts. I think he's thinking big picture, though. I think he's thinking we need to completely think about we need to rethink the way that this company goes forward from here. He's fired Ted Colbert out of defence and space. It feels like he's going to focus on the civil side of the business. That's where he sees this business's future.
So here's a business that would really like some growth, and that takes us to the UK agenda, which is a government that would really like some more growth.
Keir Starmer desperately needs growth, and today is all about that. that. That is what this investment summit is all about. If you want to spend more on services for the general public, if you want to deliver for the unions, you need growth in this economy. How does he make that happen? That is the key question. So today, I think we're going to hear a lot about, and we've already started to get hints about this, we're going to hear a lot about regulation being cut. We're also going to hear about regulators potentially being given the message that they need to take a more pro-business position.
Yeah.
That's all very interesting. But here's the problem. You come here as a business leader, you still don't know what's in the budget, still don't know what the tax situation looks like, and we still don't know what the industrial strategy
And we have to wait until the 30th of October to get all of that. In the interim, he has words for business, and he's going to deliver those today, as you say, perhaps some of it around red tape and regulation. He has had a win over the weekend. 14 big financial institutions putting their names to a letter, writing to the Times, saying now is time to invest in Britain. And this includes UBS, JPMorgan, Goldman Sachs. So he might be preaching to the converted a little bit today when it comes to some of the big messaging, although very much subject to hearing the detail in the budget.
But he's also tapping the heads of some key companies here. We talked about the Darktrace alum joining chairing the investment summit or the investment council. I think over the weekend as well, the head of Microsoft UK is also expected to head the Industrial Strategy Council. So it's interesting that they are tapping these very senior people who know how to operate in this environment, and the government needs their help.
A lot of private sector experience then into government. We will have an exclusive interview with the UK Prime Minister Keir Starmer. He'll be speaking to our head of economics and government, Stephanie Flanders, at the UK International Investment Summit. That is at 2:30 p.m. London time. We'll also be hearing from the CEOs of Barclays and Lloyds Banking Group, who'll be in attendance, some of those gathered there, listening to what's happening in the room. They'll be both live on the Pulse. That's at 9 a.m. London time.
We've got plenty of guests coming up to discuss all of this. How high should China's growth rate really be? What does it need to be? Julian Howard from GAM Investments is going to talk us through investment positioning, both here in Europe and in the United States and, of course, in China. 7:30 UK, TS Lombard, Stephen Blitz is going to be joining us. He's visiting from New York. Give us an assessment of the US economy. We need to figure out what is happening there. And at 8:30, China watcher George Magnus reacting to the latest stimulus pledges. Again, the message is this enough? What kind of structural reform do we really need to see to turn around the Chinese economy? I have to say, many of our guests today unconvinced that China has gone far enough yet, Kriti.
It's certainly something we're going to be keeping an eye on and what that rhetoric out of China actually looks like. Let's talk about what else we're watching during the week. Today, of course, the Paris Auto Show does begin. Our very own Oliver Crook is on the ground with some really interesting interviews, really interesting graphics as well. But then we're back into the earnings seat tomorrow. We got those U.S. bank earnings. Is it just JPMorgan and Wells Fargo that are outperforming? You're going to see it show up in the bottom lines of Goldman, Citi, Bank of America, and the others as well. Then plenty of data when it comes to UK inflation, employment data, retail sales over in the States, and then, of course, that ECB rate decision on Thursday. There's a lot going on. And on Friday, we circle right back to China. That Chinese activity data, retail sales, industrial production, all showing up by the end of the week.
And so the ECB firmly in focus when it comes to rate cuts in that story.
I want to compare and contrast, or put Starmer and LaGarde in the same bucket here, potentially. Both desperately need to turn sentiment around. Both need to improve the sentiment around the investment case. Keir Starmer does that today with the investment summit. Christine Lagarde does it potentially with a rate cut. Are either going to work?
Yeah, indeed. And when we're looking at the ECB, there's been a real fast turnaround in expectation, hasn't there?
Yep.
September, when we had the meeting then, there was a sense that you'd now really have to wait till December until we got another cut, and yet things have deteriorated. Some of the survey data has deteriorated at such a pace that now the market is expecting 25 basis points. And we have some nice survey data out of Germany in particular, talking about economists there expecting another contraction in the third quarter, so into recession for the German economy.
Well, I'm curious to see how much in terms of the dialogue is going to be mirroring perhaps what you saw in the States as well. Remember, there was this 50 basis point cut in the States and then real divergence about whether or not that was the right approach. I'm curious if we see that started to be reflected in the ECB as well. Of course, catering to a very different region, but saying, do we need to start catering our approach, being more aggressive at the start, then going to gradual or flip approach?
Still come back to the problem. The ECB has to do this. The ECB is being pushed into this. It started off gradual. Now it's got to deliver extra rate cuts because the growth narrative is so grim. If you take a look at this from an investment point of view, why would you put money to work in Europe right now? Why would you not just simply, as many people are, continue to put money into the United States where the Fed can cut because it can cut?
Yes, and maybe it is the ECB's, maybe the labour market is the ECB's problem more than it is other markets' problems.
Ironic.
And we have a nice story out this morning talking about labour cracks in Germany in particular, BASF, ThyssenKrupp and the like. And Mario Centino, really interesting voice at the ECB because he's a labour market economist, and so he's even flagging concerns around cracks in certain labour markets in the European area, the Eurozone. And so that's certainly something we're going to keep an eye on.
It absolutely is, and it's going to be another piece to keep an eye on whether or not they talk about the geopolitics of this all as well. That's going to be a key focus. And you asked about what the incentive to invest in Europe is. Isn't it just juicy deal premiums? You take on the higher risk, you get a higher reward. At least that's the theory, maybe, behind investing.
There's the theory. Let's talk about some of the other things that are coming up in the programme. Later today, we'll be speaking with the CEOs of Stellantis and Renault, as well as a host of other leading figures from Europe's auto industry at the Paris Motor Show.
Yep. Plenty more to talk about as well. We've covered some of the main events, but let's talk about what else is going on. Fitch Ratings has put France on a negative outlook. This after Michel Barnier's government announced 60 billion euros of spending cuts and tax increases in next year's budget. Fitch had already downgraded France from AA to AA- last April and now says that it expects a, quote, steep rise in government debt towards 118.5 of GDP by 2028. We will watch the OAT opening in a moment. China's military is holding drills around Taiwan that it says are a warning to the self-ruled island's government to halt what it calls separatist acts. A spokesman says the exercises involve the Army, the Navy, the Air Force and the rocket forces. Taiwan's defense ministry says that it has dispatched forces to respond. And the United States is sending an advanced missile defense system, including troops to man it, to Israel. In response, Iran's foreign minister says Tehran has no red lines in defending itself from threats and that the US is putting lives of its troops at risk. Let's get more on this story and figure out what's been happening over the weekend. Bloomberg Horizon's Middle East and Africa anchor Jumana Basechi joins us now. Jumana, let's start with this air defense system that is being sent to Israel.
Yeah, that's right. So the Pentagon announced yesterday that it was sending this high sophisticated defense system called the THAAD system, Terminal High Altitude Area Defense Battery. That's what the acronym stands for, alongside about 100 troops to help operate that system. It is notable because this is the first time U.S. forces are being sent to Israel since October the 7th. And yesterday, President Biden was asked about it. He said that he had ordered the Pentagon to deploy the system to help defend Israel. And of course, this comes ahead of a widely anticipated Israeli response to the Iranian ballistic missile attack that happened on October the 1st. It is expected to happen at some point in the near future. But it is interesting as well that over the weekend, the Israeli tax authority actually announced that the damage sustained from that October 1st attack amounted to about $40 to $53 million, which tells you that not all of the missiles were intercepted and that some damage was actually sustained on the ground, underscoring the fact that Israel may need some bolstering in its air defense system. Also coming at a time overnight where Hezbollah fired further rockets into northern Israel. Today, the IDF has said that 4 soldiers were killed, 7 critically wounded and as a consequence of those attacks. This, of course, as the conflict continues to expand. Over the weekend, IDF announcing that they had dismantled further Hezbollah military infrastructure in the southern part of Lebanon, ground incursions continuing there. Also, a tit-for-tat going on between IDF and UN peacekeepers deployed in the southern part of the country as well. This has become a bit of a diplomatic situation, with this morning a statement being put forward by the EU saying they condemn all attacks against UN missions because several peacekeepers have been wounded in southern Lebanon. Alongside that, also ongoing military siege in northern Gaza, with 400,000 residents told to evacuate. Further airstrikes taking place in northern Gaza, also central Gaza this morning as well. The death toll is more than 40 per the latest figures put out by the Gaza Health Ministry. So expanding conflict, but what we are hearing is further a defense system being put to the use of Israel in anticipation of this likely Iranian ballistic missile response.
We continue to watch for escalation there. Then, Jumana, thank you very much. Horizon's Middle East and Africa anchor Jumana Basecha. Coming up on the programme, we will look ahead to Bloomberg's exclusive interview with the UK Prime Minister Keir Starmer. He might be ripping up all kinds of rule books today when he addresses business. We will have a focus on that conversation. Plus, the Paris Motor Show kicks off today, and we're on the ground where we'll be speaking to key figures in the sector. Up next, Chinese markets turn around after the weekend provides little detail on the government's next steps, but something seems to be igniting some positivity. We'll discuss that. If you have any questions for our guests, please do get in touch. IB plus BBTV Go. That's the function to use this morning and every morning on the Bloomberg terminal. This is Bloomberg.
think what's interesting is that for the past kind of, I guess, 2 years or so, global investors can just forget about China. Now, with this kind of like stimulus and this round of policies, you can't ignore China anymore. If you look at like the manufacturing PMI is still below 50, so I mean things are still rather weak from a cyclical perspective. However, if we look kind of forward to 2025, we think that that part of the economy is going to start to recover, and that could actually prompt good inflation to kind of go up higher.
Statuary CIO Stephanie Leung saying you can't ignore China anymore. You may have done for the last few years, but that moment has now passed. Should you be getting excited about China, I guess, is the real question. You can't ignore it, but should you be getting excited about it? Is 5% really enough? Julian Howard, Chief Multi-Asset Investment Strategist at GAM Investments, sitting around the table with us this morning. Can you ignore China? Should you be excited about China? What's your view on China?
Can't ignore it because it's a significant part of the MSCI All Countries Index. It's over 2-3% now. But I think Saturday was a bit disappointing. There was a postponement of the actual fiscal numbers that everybody wanted to see. And I think that was a little bit frustrating for investors. And I also think there was a bit of a missed opportunity. You know, China is actually ripe for significant supply-side reform. For example, they could liberalise, the rural property market, and by some estimates that could raise growth to 8%. But that wasn't even looked at. This is really about sort of bailing out local authorities. So it feels a little bit sort of Japanese style in terms of trying to recapitalise and bail out, and it just feels like a secular stagnation story that's hitting China at the moment.
So what do I do as an investor?
Well, I mean, our position is to be engaged, but not particularly overweight. I think the fact that the Chinese market is so beaten up, and then you've got a little bit of good news versus no news, I think is positive. So I think that'll be good for the market itself. And I think we saw this morning that actually it was quite a good start to the session. But it doesn't mean that China's going to go back to a sort of 5.5–6% kind of growth economy. I just don't really see that because there wasn't really enough in Saturday's announcement. And there's not really enough in terms of what they're looking at, the broad parameters of what they're looking at. It's kind of fiscal and just piecemeal reform, interest rate, fiddling around with interest rates. There isn't really that big kind of great leap forward like we've seen periodically in China, like in 1978.
He's not convinced.
Yeah, he's not convinced. Julian, you're not convinced.
But not underweight either.
Okay.
Not underweight either. Because we think there will be a bit of a short squeeze. I think that's what's happening.
So what would be better? What would move the dial?
Well, like I said, some significant supply-side reform. You can't buy or sell property in rural areas in China. I mean, can you imagine a country where literally half the property market cannot be traded? If you could do that, that's a quick win. It's not going to cost anything. It's liberalising the market, and it would be really, really significant. And I think it's just that missed opportunity to do something profound here.
OK, and then away from the China story, you still like stocks. And you have nice words of caution for us in your note, or not caution, but a reminder, saying the long-run returns on equities are net of human chaos. So we shouldn't let a lot of chaos distract us and remember that, the story can still be positive for stocks. Yeah,
so Jeremy Siegel, who's the sort of godfather of buy and hold, he has this observation, which is that you get 6.5–7% from US equities in real terms over the long run, over a multi-decade period. So that's been through the Cold War, it's been through everything you can imagine, pandemic, conflict, political uncertainty. So whatever's going on now, it's always worth taking a step back and considering actually that return over time, and you can't always predict exactly when it's going to happen, but as a compound rate over time, you will get that, because that is, in a way, it's a proxy for sort of human progress, actually. It's the rate of return on human progress. So I think that's always worth bearing in mind, however chaotic things seem in the very short run. That said, the US equity market's actually done well in the short term as well. So it's not just sort of ridden the storm long term, but it's just carrying on doing well. Earnings are good, economic growth is good. I think it's really marked out versus other markets.
Yeah, new all-time high on Friday.
Yeah. How much of that is a reflection, though, of that economic resilience that you're seeing, as opposed to more of a defensive bid from international investors? Where is the bid for U.S. equities coming from?
I think it's a bit of both, but also if you look at the sort of US corporate landscape, there's better return on equity, quality of management is higher, you've got the technology sector, so there's all sorts of things that other markets just don't have. I mean, I was talking to Guy earlier about Europe, and it just doesn't have any of those things. It's very hard to get excited about Europe, but it's quite easy to get excited about America. There's so much going for it.
Hasn't that been the case for almost 30 years, though?
It absolutely has. And if you ever speak, I'm sure you have lots of European equity managers here who show you the chart of the discount, percentage discount MSCI Europe versus MSCI.
Yeah.
Isn't it cheap? But it never changes. It's a perma discount. You know, and you can't keep arguing that there's a discount unless you've got a really strong case for that discount window being closed. But it just never closes, really. And I think... Sorry.
So you got ECB this week, Christine Lagarde. You got Keir Starmer out on deck as well. He's going to be giving his update on what he thinks needs to happen with UK growth. What's the advice? How does what needs to change in Europe to get us excited about the investment case for Europe? I
think political consensus would be really, really helpful in terms of being able to implement reform. Europe desperately needs supply-side reform in a way that sort of China does as well. And there is no political consensus. You look in Germany, the only thing they've agreed on recently is legalising marijuana, gender self-identification. Those are good things. There's nothing wrong with those. But they're not as important as boosting growth. And Europe desperately needs a growth plan. We've also got an issue with Ukraine. I mean, what if Ukraine actually loses this war? You know, Russia is on the ascendancy, and Donald Trump has threatened to finish the war in one single day. So Eastern Europe could have a Russian neighbour in a relatively short period of time. And will Europe step up to try and defend Ukraine? There's no money left to do that. So there's a risk premium that I think needs to be taken into account that people aren't really talking about much.
Yeah, I was going to ask you, Julian, when you mentioned the things that Europe was not agreeing on, or, you know, the big picture things they weren't agreeing on, I was going to say, well, does the politics lead us to conclude that any of that will be possible? Because it looks very fragmented and there's lots of sort of pushback against European projects. But then you talked about the security threats and defence, and you wonder whether that's what coalesces Europe into realising that they need to take action.
Yeah. Well, the one thing is, I mean, actually consensus is only half the picture. You would actually also need the money to be able to actually put up a defence against Russia. And you know, France having to raise 60 billion euros, you know, this emergency budget that's coming through. So there isn't the money. Even if they had consensus, what would they do? They need to spend money at the same time. They don't have that either. So Europe's position is pretty dire. And the ECB can help a little bit with rate cuts, but it's not the whole picture at the moment.
Well, Julian, from an investment standpoint, though, and I take your point about the geopolitical threats, you heard from Jamie Dimon making a very poignant point, for lack of a better term, about the risks that are growing around the world. Europe is trying to throw money at the defense sector, to your point, isn't able to. But from an investor standpoint, is that where you go? Is that where the juicy premiums are because there's this argument that that's where the funding is going?
Well, there also needs to be consensus on how much is assigned to defence. I mean, I think that's the other point, and how quickly those defence companies would actually benefit. So, again, that's not really clear from this perspective. All of it is kind of risk-laden. As you look at the case for the US, it's just so much clearer. I mean, we're having to really dig deep, aren't we? All sort of trying to find, well, maybe defence, and maybe this sector, maybe... But it's just none of it's obvious. So as you look at America, you've got consumers doing well, AI technologies doing well.
Yeah.
You look at companies like AMD, they didn't even have a kind of AI chip-making business, and they decided to start one up a couple of years ago, and now it's worth $1 billion really, really quickly.
Yeah.
You can't compete with that. You're having to sort of dig around in the dirt to try and find a case for Europe. But it's not going to close that discount window at an index level. It's
well, I wonder if the case for Europe then ends up coming at the expense of the U.S. Post-election. Julian, a conversation for another time. We thank you so much for joining our show. Julian Howard, Chief Multi-Asset Investment Strategist over at GAM Investments. Coming up, we're going to stick with that story about the U.S. equity picture. There's no stopping the S&P 500. This bull run continues. Records high for that U.S. index. We're going to dive into the details next. Stick with us. This is Bloomberg.
Minutes in the start of the opening trade this Monday morning here in Europe. Looks like we're going to see actually a fairly flat open here in Europe. It looks like London may underperform. You may see some of the commodity stocks doing less well. We are seeing iron ore under a little bit of pressure. In particular, I think you're probably looking at maybe oil down as well, so that could lean on London a little bit.
Yeah, absolutely, that could. And interesting that, you know, the US session on Friday, if we're taking any lead from that, and it was a new record, but it didn't do much after we closed up here in Europe. You know, it made a lot of the gains in the early part of the US session, so there's not much to sort of pick up on and catch up with in the European trading day, so European futures are flat. In terms of the bond market story then, we do have a little bit of movement on the French story. We've seen a downgrade to the outlook for French debt from Fitch coming through, and as a result of that, we do see some selling of French debt, certainly at the 10-year horizon. I see a little bump up in the French yield as a result. Elsewhere, we see the opposite. So it does seem as if France standing out a little with that in mind. So US stocks hitting a fresh high on Friday, with the S&P 500 closing at a record for the 45th time this year. For more on this, let's bring in Bloomberg's Valerie Teitel. Valerie.
Anna, yes, it was another record high for the S&P 500 index on Friday, the 45th of the year, and we are now on track for 5 straight weeks of gains. That is the longest winning streak since May this year, as the S&P 500 is now up 22% on the year. Anna, what a number. But taking a step back, I want to talk about the U.S. growth picture. I know we have a U.S. economist with us around the table this morning. I want to put to him a question. We've seen the Atlanta Fed GDP now, which is a running estimate of the third quarter GDP for the U.S. rising over the last few weeks, is now at 3.2%, with the median economists on the street looking at a 2.6%. Are we looking for further economic upgrades when it comes to the U.S. picture? And has this U.S. exceptionalism trade just begun?
Valerie, thank you. Nice question to put to our guest. Thank you very much for that, for setting that up. Let's talk to Steve Blitz, who's the chief US economist at TS Lombard and regular visitor to Bloomberg TV. And thank you for coming to see us here in London, Steve. Let's start with what Valerie was talking about there then. The Atlanta Fed GDP now suggesting third quarter growth at 3.2%. Do we need to upgrade growth in the US? Do you think estimates are going to be on the rise from here? Perhaps we're not sort of putting the growth story in the rearview mirror. Perhaps there's a lot still to play for.
Yeah, I mean, I think the way to think about it is that so many people have been downgrading growth and downgrading it. Maybe they're the ones that have to eliminate the downgrade as opposed to upgrade it and just sort of reflect on the reality. You know, a lot of people, you know, on one side of the political ledger have been saying that we're still in recession. We're in recession. We've been in recession for a year now. But when you look at earnings of companies, they don't tell you that, and those numbers aren't lying. You know, so the real issue, the real problem gets to the Fed. Mm-hmm. And the question is, what is neutral for the funds rate?
Yeah.
Because if we're growing at 3% with a 5, you know, in the third quarter, we've had mostly a 5.5% funds rate. So you have to ask the question is, gee, something's changed here. Because if we had that funds rate, say, in 2018, the economy would have crashed.
Mm. And so how much, with that in mind, how much cutting are you expecting the Fed to do from here?
I still think the Fed, looking forward and really more biased against recession than worrying about the upside in inflation. I think there's probably 2 more 25 basis point cuts coming to 4%. Let's call it 4.25. The bottom half of the fours, right?
Yeah.
And I think that's where you get to. I think the market has always been a little bit over its skis, as the expression goes. A little early for that, I guess. But in terms of thinking that the Fed was cutting all the way to 3%, which was always based on the idea that we'd be trending at a 2% inflation by next summer, and I just don't see that happening.
Where are the cracks, though, Steve? I mean, if you look at some of the commentary that you're seeing in, say, Seattle property prices or the workflow in certain sectors, there are still elements of this wealth gap, of these layoffs that are showing up in certain sectors that haven't seemed to risen to the top when you look at the data. What other cracks are you seeing?
Well, we were seeing some cracks in the summer, right? And I think that especially in housing, which is and construction generally, which is very sensitive to interest rates. But those seem to have begun to sort of fade away a little bit. And the key point here was beginning to lower the cost of financing. You know, we focus on the 10-year because 10 years where mortgages are priced. 10 years really the benchmark yield for the equity market as well. So when that comes down, everything else is presumed to do better. But there is a cost of financing to business. And when inflation is running at 2.5, 3, and you're paying over 5.5 for short-term money, that would begin to crack the economy. You know, you have negative carry on physical inventories. So that begins to change the way people act. You can't build a house because construction loans are 3-month loans.
Yeah.
So all these places. So now you've lowered that. You're going to lower it more, and that really resets the economy to do well. Because honestly, if you look at this expansion, if you measure it from 2019, because of the 2020 thing, this has really been an expansion built on government spending. You know, when you compare it to the one before from 2007 to 2019, it's really been a government-led expansion. And so the private sector really hasn't taken off yet. And so, and that is where the next round comes from. At least we hope so.
Well, some would argue that the expansion that you're pointing to from the government stimulus and spending that they put, which is a completely fair argument, some of it's also coming from these massive labor productivity numbers as a function of immigration as well. Where do you stand on that? How much of the resilience that we're seeing in the U.S. is really a function of immigration?
Well, let's start with the immigration, then go to productivity, okay? So if people are talking about this like, oh, gee, this is so horrible, you know, this is all because of immigration that we're growing. Well, doesn't that argue to have more immigration going forward as opposed to less? Now, I understand the issue of legal versus illegal, controlling who comes in. I'm not getting into that particular, area. But if everyone's going to tell me that, all this growth is because you had added this many more people to the economy, then that seems to argue that you should add people to the economy, okay, admittedly controlled way and all that, going forward, not against that. And on the productivity, got to be real careful with the U.S. on these productivity numbers. There's good productivity and bad, so to speak, in terms of what it means for the labor share, what it means for real wages. But when you're adding productivity because you're boosting imports, and therefore, Nike, Apple, pick your company. I don't mean to pick on those two. But are basically all the man hours are overseas and they're importing for a nickel what they're selling for $1. It looks like higher productivity because that's output per man hour. Yeah. So you really have to be very careful. People throw around, well, inflation's lower because of productivity. Yeah, well, that's because you had a very strong high real rates, very strong dollar. You're bringing in a lot of imports. And, in fact, the other part of the economy, aside from government spending, that's grown a lot since in this cycle versus the prior one, is imports.
I'm going to bring right back to the immigration conversation as well.
Sure.
We'll take the politics out of it. Do you, in your election modeling, if there is some sort of change to the immigration policy, does that have a material effect on GDP numbers, on payrolls numbers, or even rate cuts and Fed policy down the line? Is that something that even matters in modeling that right now?
Well, it's hard to model, but clearly, if you're growing the economy through higher immigration, there's an immediate price effect, which is higher prices because you have more people buying stuff, and the supply side hasn't yet adjusted. But over time, you get better real growth. Now, the Fed's is never going to react to what they think might happen in terms of policy. They're always going to react to what's in front of them. So it's so from a Fed policy standpoint, they're not really looking at whether this is immigration or not. I mean, their research, they look at it, but it doesn't really affect very much in terms of what they're thinking about in terms of where to set interest rates.
Steve, let me ask you a question you don't know the answer to.
Oh, good.
How big an
effect?
effect?
Ask me two like that.
I can ask you two or three, don't worry. How big an effect is the US election going to have? You talk about the fact that government spending has driven the growth story. We're about to see a change in government, potentially, one way or the other. It'll be interesting to see what impact that has. Can you model it? Can you think about it? Do you understand what the policy is going to do to expenditure, to debt, to growth?
Yeah. You can.
There's a big pause here.
Yeah, you can and you can't, and I don't want to be too political about this because I think, let me put it this way. Ever since George W. Bush came in as president, right, and he and the Republican Congress eliminated the Gramm-Rudman cap on federal spending, there's been no adult in the room, regardless, Republican, Democrat, Republican Congress, Democrat Congress. It's been a bipartisan effort. Okay, their direction is different, but in terms of what they want and what they want get passed. But in the end, you have a structural problem with the deficit, with the budget, where you have spending growing, set to grow over the coming years at a faster pace than revenue. And there isn't an adult in the room, and I don't care. I do care who wins, but regardless of who wins, I think it's the more better way to phrase that. Regardless of who wins, I don't see an adult entering the room on the
Okay,
deficit.
if there are no grown-ups, where is the US tenure?
Eventually?
Well, no. Assuming that the grown-ups aren't in the room and spending continues and the deficit becomes a problem, do I have to assume a higher 10-year rate?
Yes.
By how much?
Well, it depends on your time frame, but eventually, if you to say that you can get back to a 6-7% 10-year yield over the next several years, I'm not
several years being 2 or 3, 4 or 5.
Say 3, 4.
Okay,
we'll split the difference. But I would say because it's very hard to because the Fed now is the Fed's in an interesting spot with its balance sheet. It can keep the 10-year from getting too high, but then it has to go back to expanding its balance sheet in terms of buying the debt. And even then, something like 30-40% of its reserves are foreign banks. So that means foreign depositors in those banks want to hold dollar deposits, right? And so through that, they own the treasuries as opposed to directly. So then the question becomes, can you hold those in at what rate? So it becomes a real balancing act, and you can set this in motion to a bad outcome, to a good outcome. I want to keep it to a good outcome, but I think it's very difficult to come out to an outcome where you don't get back to a 6%, 4% funds rate and a 6% bond. And by the way, if you have strong real growth with that and productivity as well. The world did very well in that kind of environment. There's nothing that says
that's old school.
It's old school, and it was good for everybody. So it's not necessarily a bad story.
No. You can make the maths work. It's great to see you. Thanks for stopping by.
Thank you.
Steve Blitz, Chief US Economist at TS Lombard. Thank you very much indeed. What else have we got coming up? Will the UK roll the dice on a new gambling tax? We're going to take a look at the bookmakers ahead of the budget on October the 30th. We've got an investment summit today. Stocks to watch coming up next. This is Bloomberg.
Welcome back. 7:46 here in London. So 14 minutes until the start of another trading week here for Europe. The futures picture looks pretty flat. Don't have a great deal of catch up with the States to play for this morning. But actually, perhaps that futures picture improving a little bit, except for the FTSE 100. In terms of the US futures picture, that is pretty flat to negative this morning. Let's talk about the markets then. Our Markets Live executive editor Mark Cudmore joins us. Mark, let's talk about China and what we've got. We had a host of things to watch around China, and then we had the market reaction. The market reaction seemed extremely muted until something turned around. Give us your take on the weekend and the trading day that was for China.
Yeah, good morning, Anna. I guess it feels like a muted reaction when you walk in Europe, but it felt pretty volatile in the Asia session. Originally, we were surprised by how positively stocks were trading. Then they suddenly turned very sharply negative right across the board. And then they traded better into the lunch break and have traded okay since then overall. I think the main takeaways today are, hey, we haven't got the big bang. We haven't got the kind of bazooka number everyone was hoping for. So it's definitely not exceeded expectations. But I think people are realizing that there's a lot of smart messaging here, particularly in the focus. Today, the press briefing was mainly about helping particularly the private tech companies and entrepreneurs. And that's a very important sector to support, to again encourage animal spirits and investment in the market out there. I think there is a growing belief that, hey, China is not going to enact the measures that sees another big bubble form and therefore sees stock gains at the pace that we've seen over the past month, but that overall they are going to increase on doing measures until the markets are sustainably rising, just maybe at a more gradual pace.
So what kind of time frame are we thinking about, Mark?
Look, I think stocks are much higher over the past month. I think stocks will be higher over the next month. I think stocks will be higher over the next 3 months. I think stocks will be higher over the next 6 months. There's a risk that they're in another boom and bust cycle in terms that they don't actually fix the deep underlying economic problems. But for now, all the senior kind of facets of the government in a state-directed economy have said, we are going to get the market higher. That is basically the message. So they're going to do enough measures over the coming months to ensure that they get that bit of confidence out there. Now, this does not mean that the market goes massively higher, but I just think that we're going to start correcting the deep discount, deep undervaluation that these stock markets have relative to many global peers in what has been a sustained bull market in the rest of the world.
Mark, talk to us a little bit about that ripple effect, if you can. Is the Chinese stimulus story still kind of restricted in terms of its kind of net effect to Asia, or is there something that we're expected to see show up in the States, in Europe, et cetera?
Yeah, that's a really good question, Kriti, because I think that's what people are starting to realize. Hey, if they're not, doing such a big fiscal package that they're going to really suddenly boost the economy, they're not really changing the economic narrative massively. What they're doing is important structural tweaks at the margin to make the system work better. So the spillover effect is much less. Now, obviously, it'll be good if China gains even a little bit of confidence and Chinese markets do better. So there'll be some positive impact, but this is not like a narrative that we can trade into European markets, for example, that very much matter on the Chinese economy.
Certainly something we're going to be keeping an eye on. Bloomberg Markets Live executive editor Mark Cudmore joining us this morning. You get more up-to-date analysis from him and the team. Just type in MLIVGO on your Bloomberg terminal. Let's go from the macro to the micro. Get to Joe Easton with our stocks to watch. Joe.
Morning, Kriti. So the UK gambling stocks are set to be a big focus today after the Guardian newspaper reported on Friday that Rachel Reeves, the Chancellor of the Exchequer, is looking at a potential £3 billion tax raid on the sector at the end of this month in the upcoming budget. And we saw a big drop in Flutter Entertainment, which, remember, relisted over to the US just a few months ago. That stock down 9% at the close of the post-market trading over there. And we will be looking at the other UK rivals today, particularly Entain, the biggest one. Then we've also got Evoke, previously known as 888, also Rank Group and Playtech. All of them could be in focus today. But the analyst notes that I've been reading have actually been saying that potentially it won't be as severe as the Guardian report did suggest. And a good quote coming out here from Goodbody saying that while they expect some weakness in gaming shares today, we do not believe the budget will prove to be the existential crisis that the move in Flutter's shares actually suggested on Friday. So they think potentially overdone, but we are just seeing breaking news in terms of the Entain share price over on Tradegate, down 7 to 8% this morning, so potentially going to be a big one today. Then over in the oil space, we've also got numbers from Aker BP. This is the big Norwegian oil firm, market cap around 15 billion euros. Also, remember, the UK's BP is still one of their big shareholders. Now, this stock has underperformed recently, given some production issues, and today they are saying that their production has once again declined, kind of in line with what we've already seen out from the likes of BP itself, also Shell, ExxonMobil, and all the analyst predictions in terms of the oil price coming down further as well. Then over in aerospace, we are keeping an eye on the suppliers to Boeing, also the customers and the rival Airbus as well. This is as Boeing is cutting around 10% of its workforce and booking a big multi-billion-dollar charge due to the production issues that we've seen there and also the strikes as well. So will we see a feed through into Airbus and also those suppliers? As I say, Ryanair still needs more Boeing planes, according to their CEO. Finally, on the analyst rating changes, we have got some interesting ones. There's the Boeing share price on Friday. That was down 0.9%. But in terms of the ratings, we've got Equinor. That one's raised over at Morgan Stanley. They have recently flipped their rating on that a few times. BASF, the chemicals firm in Germany, cut to neutral at UBS. And finally, an interesting one from Citi, which has actually got a pair trade recommendation. Underweight L'Oreal, overweight Beiersdorf. All of those could be in focus this morning.
So am I downgrading to Nivea? Is it a downgrade to Nivea? I don't know. Anyway, skincare is important, I'm told. Joe, thank you very much indeed. Joe Easton joining us on what single stocks we're going to be watching into the open. France is also going to be interesting today. The downgrade on Friday potentially rippling into some French stocks as well.
Yes, it seems that the movement in the bond market is a little more in the mix now, though, isn't it? Yeah. Rather than standing out to in the other direction. Certainly at the 10-year tenor, I can see we've got bids for France, for Germany, for Italy, and yeah, France is moving less of a bid, but it's still moving in the same direction as the others, which wasn't the case 25 minutes ago.
It is, but by a significantly lesser margin. You're seeing about a 9 basis point move in German debt. France only getting a bit by about 3 basis points. I think it's crucial here that this is changed based on an outlook change, as opposed to the fact that we kind of already knew that so much of this deficit story was going to weigh over this market. It's not showing up, however, in the futures action if you look in the equities market. So perhaps a little bit of a disconnect between equities and bonds.
Yeah, because there's nothing new, really. It's, they've taken some action on the outlook, but the things that they are flagging, they're talking about implementation risk around the spending cuts. everybody knew that there's implementation risk before.
But a downgrade, is this a precursor to a downgrade?
Yeah,
and what impact would a downgrade have?
Is
a downgrade fully priced at this point?
But in terms of how much equities react in the short term, maybe.
I think equities may be more reacting to what we know in terms of the tax story and how these French companies are going to be hit potentially by that story. We also don't have a steer in the bond market from the Treasury market today. It is Columbus Day. So and Japan as well, kind of factoring into the mix there. So we don't have that kind of obvious bond market steer that takes us into the European bond market story this morning. But it is a big week. Got the ECB coming up. That's going to be fascinating. Can Christine Lagarde generate growth within the Eurozone? Can Keir Starmer generate growth in the UK?
Yes, coming at it from with different policy tools, of course, but we have an interview with him. That's coming up later on today. Keir Starmer speaking exclusively to Bloomberg from the Investment Summit that we'll be hearing a lot from him and his team, of course, trying to lure international business to the UK. But what can be promised on the growth side? We will certainly bring you that exclusive interview later on today. In terms of the market open, then, we're just 5 minutes away from that. We'll bring that to you. The futures picture, the FTSE going in the other direction to the others. We'll be back with the market open. This is Bloomberg.
Monday morning, good morning. It is Columbus Day, so we're going to call the white line today the old world, and we're going to call the blue line today the new world. Unfortunately, the new world doesn't give us much of a steer for the old world this morning, because what we saw on Friday was a decent rise towards the back end of the session here in Europe, which basically reflected what was happening over in the United States. We've got the bank numbers coming out. JPMorgan delivered. Wells Fargo delivered. The numbers look good. But then we kind of drifted sideways for the rest of the session. It is Columbus Day in the United States. The bond markets are closed, but the equity markets are open, Kriti. So what are we seeing in terms of the futures picture?
Well, not a whole lot of movement yet in the futures picture, although what's interesting to me is that there is a clear outperformer, even by the tiniest margin, and that's over here in the French index. Those futures higher by about 0.1%, although in retrospect, or in comparison, I should say, you're seeing it underperformance in the UK, down by about 0.2%. Net, your Stoxx 50 futures seeing basically flat. Anna, I'm curious how those French stocks really trade at the open. Are they going to be responding to what we heard out of Fitch on Friday?
Yeah, we'll see whether they find anything new in there, whether they, we'll see where they go on this one, because we've talked a lot about the negativity around French stocks. We'll see how the China data plays in for the French stocks, of course, because that could add to complexity in trying to work out where these markets go from here. In terms of other stocks we're watching, UK bookmakers, so this is betting companies in the UK. Could we see those in focus when we get to the budget at the end of this month? Yes, another day, another story about what could be taxed here in the UK, and this was from The Guardian on Friday, and it certainly moved US listings of UK bookmakers. Aker BP, new production stats out there. Airline sector in focus as we got those steep job cuts then from Boeing, Guy.
Absolutely. Right, here we go. Monday morning session, time for the old world to get going. Here we go. The opening trade is upon us. Let's see what the numbers look like. We're not expecting a clear sense of direction, really, out of Europe. I think the London market may suffer a little bit. We've seen some volatility in the commodity space. That may get read through. You'll also see, as maybe going to see, as Anna suggested, maybe some action in the gambling stocks. We'll keep an eye on all of that. The airline sector could be important today. You've got Ryanair in focus, Lufthansa. Keep an eye on what is happening with those two stocks as well. So the Stoxx 600, just positive. The FTSE 100, just negative. The IBEX, absolutely flat. The DAX comes out of the gate. Obviously, nothing happening in Germany because it's early. We're up by 0.2%. The CAC 40 is up by 0.1%. We've almost got a full sweep. We'll wait for the Swiss to get going. In the meantime, let's take a look at what is happening at a single stock and a sector level. Kriti, what's going on?
Well, when you look at the index contribution, it looks like right off the bat, I should say, pharma, biotech seems to be the outperformer, although fairly broad gains that you were seeing in the European session. Look at the biggest index contributors, though, to the Stoxx 600. It's AstraZeneca, it's Roche, it's Novartis, and then it's followed by your sensational six, your ASMLs, your SAPs, and of course, it goes further and further down. When we're talking about the underperformers, though, Anna, it feels like commodity is on the back foot. Maybe that's what's weighing on the FTSE 100.
Yeah, energy also on the back foot, and we do have an oil price down by 1.3% this morning. Back to the top of the pile, Kriti, another sector in focus, auto and auto parts. We've got, another of the core six moving higher. Ferrari doing well. We've got an auto show taking place in Paris, so we'll see whether that generates sufficient news flow to turn around any sentiment in that sector. Travel and leisure currently the worst performing sector, and that is where you find those gaming companies. So that's an interesting one to watch there. And we do see a little bit of weakness coming through on some of the gaming companies, but Entain yet to open, I note.
So oil stocks are down. You also got some of the luxury names down as well. So LVMH is a little bit softer, but in terms of where the points are coming off, it's Novo Nordisk. It's Rolls-Royce. It looks like BA's got a bit of an issue with its 787s and the Trent engines that it's running on those, which are causing some cancellation for some long-haul flights. So Rolls is down maybe on the back of that, but it's had a great run. Siemens is also a little bit softer this morning. BP is softer as well. So, there's a bit of a China read across, I would say, in this, plus a few idiosyncratic stories that we need to focus on.
Plenty to discuss there as well. Let's go right through the valuation stories. We're waiting for more of this to actually shake out here. Julian Howard was just with us earlier from GAM Investments. He was pretty downbeat on Europe, citing fiscal and security risks. Take a listen to what he had to say.
So there isn't the money. Even if they had consensus, what would they do? They need to spend money at the same time. They don't have that either. So Europe's position is pretty dire. And the ECB can help a little bit with rate cuts, but it's not the whole picture. There also needs to be consensus on how much is assigned to defence. I mean, I think that's the other point, and how quickly those defence companies would actually benefit. So, again, that's not really clear from this perspective. All of it is kind of risk-laden.
He goes on to say that there's a perma-discount in Europe. What we've seen for almost decades come. Let's get another view this morning. Joining us now from Paris is Lilia Paytavin, portfolio strategist over at Goldman Sachs. Lilia, a pleasure to have you on the program. We're talking there with Julian Howard over at GAM Investments about that discount between what's going on in the States, what's going on in Europe. Maybe shine some light for us on this rainy Monday morning in London, Lilia. What is the bull case for Europe?
Hi, good morning. Well, Europe is about to start its third quarter earnings season. And I must say it doesn't sound very bullish because analysts have actually downgraded their estimates going into that third quarter's season by 3% over the past few months, while going into the second quarter season, they had revised up their earnings estimates. We have had relatively weak data coming from domestic demand in Europe, but also coming from China. And if I look at the auto sector, for instance, it's one of the sectors where we've seen the largest downgrades. And our analyst thinks that might actually continue going into the season. So it's true over the past few days, we've had a big stimulus on the fiscal side and monetary policy side announced in China, and that's very welcome for Europe. And our China economist has revised up her GDP forecast for China on the back of this. So we now expect GDP to grow 4.7% next year in China. That's 40 basis points more than what we had expected. And that's great, but she's not changed, her more longer-term forecast for China. And we still have the 3D issues, as she calls them in China. So aging population, the demographics, the large debt, and deglobalization. And none of that will be changed and impacted by the fiscal package that has been announced. So that's still a drag as well for Europe.
Well, Lilia, let's zero in on that China piece of the equation as well, because it feels like the other kind of hit here is not just about the fiscal package, which, of course, is being compared to what they had in 2009, but perhaps not to the same extent in terms of the global ripple effect, but also in terms of the fiscal package you're seeing right here in Europe. How much of fiscal money going into, say, the periphery or going into the defense sector is a sustainable kind of tailwind for Europe?
Well, I think that on the fiscal side of things, developed economies are all, generally speaking, struggling. So, obviously the headlines have been around the public deficit in France that seems to be 6.1% this year instead of the 5.5% expected by the governments until the past few days. So The French government wants to raise the corporate tax, cut spending, and France is not the only country in Europe. We also have Italy targeting companies and willing to impose windfall taxes. We might have also similar measures in the UK. And the US deficit is also extremely large as ever. So I think the room of maneuver here is quite limited, and what that means as well is that long-term bond yields might not fall as much as what you would see normally during periods where you have a normalization of monetary policy without a recession. Normally, these periods tend to see long-term bond yields going down. That's very positive for the equity market. When you don't have a recession and central banks are cutting rates, obviously that's quite bullish. Now we are in probably a quite specific cycle where the valuations of the equity market have risen ahead of central bank easing. And we might, because of the debt issues, not see such a drop in long-term yields. So that's why, if you look at our forecast for the S&P, for instance, my colleagues have revised up their price targets. We have 10% upside. That's slightly less than the median annual return you get on the S&P, which is more around 12%. Okay. And this is more being driven by earnings than valuations. They actually think the valuation of the S&P could contract maybe by 1 P point over the next 12 months.
Lilia, in terms of the different parts of Europe and how they are performing right now, we have a survey of economists talks about weakness still continuing in Germany and possible recession there. We have been talking a lot about France and the challenges that France faces. How are you allocating geographically? Do you favour Spain versus others, or what's the strategy?
So in Europe, generally, since we've had basically the same currency, the dispersion of returns tends to be driven by sectors rather than by countries, except during very specific moments, maybe during the euro area sovereign debt crisis. There's been a specific risk premium allocated to Italian equities, for instance. And I think the same applies right now. Like if you look at the DAX, for instance, it's an index which has generated relatively good returns despite the fact that the German economy is on the verge of a recession. So I think it's difficult to play countries in Europe, and you need to be quite narrow. For instance, in the very specific case of France, the corporate tax will rise, and it's quite unlikely that it will impact massively the CAC 40, because that index derives only 15% of its revenues from France. So you need to play that kind of measures with more targeted baskets, for instance, French domestic companies. These ones have underperformed French international stocks by 3% over the past months, and they might, be vulnerable to further measure. And also, even with this approach, you need to be quite nuanced, because a stock like LVMH, which is international, it makes less than 10% of its revenues in France, you would think is unlikely to be impacted by the corporate tax hike. But LVMH actually is apparently paying about 50% of its taxes in France. So despite being international, that stock might be impacted by measures as well.
Lydia, how do I play China in Europe?
China in Europe, you would look at autos, basic resources, luxury stocks, basically all these sectors which have seen massive downgrades to their earnings estimates over the past few months. Our analysts basically see some weakness still in luxury names coming from Japan because the yen has appreciated, coming from China. And they do actually see some strength and resilience coming from the US high-end consumer. In terms of autos, as I've said, we've seen massive downgrades, and that might continue. So although probably most of the downgrades, I would say, are behind us, we can still expect probably, some volatility around earnings estimates for these stocks.
Leah, great to catch up. Really appreciate it. Thank you very much indeed for joining us this Monday. Leah Petavin, portfolio strategist, joining us from Goldman Sachs. Quick look at where we are in terms of the core six. This is what the picture looks like here. We have, as we've mentioned, Ferrari a little bit higher. An auto stock standing out on a day we start the Paris Auto Show. Keep making that mistake. ASML, Schneider, Nestle, all higher. Nova's a little bit softer. LVMH definitely a little bit softer this morning. That's where we maybe see the French effect coming through. Let's talk about the other single stocks we're watching. Joe's got the details.
So we got some big declines in the gambling stocks this morning, Guy, following that report in The Guardian on Friday regarding Rachel Reeves potentially looking to tax the sector by around £3 billion at the upcoming budget. So Entain really taking most of the pain here. Remember, that's the owner of Ladbrokes, down almost 15% now. Evoke, this one owns William Hill, also 888, also hit another 12%. Rank, this is Grosvenor Casinos that you see around the West End, and Playtech, which runs a lot of the bingo sites, also lower as well. But really the worst performing sector we've got today, a massive drop for Entain. That follows that 9% decline for Flutter on Friday. Analysts at the moment kind of being a little bit sceptical about the extent of the taxes, but definitely the worst performing space today. In terms of the M&A stories, now there is breaking news around Singapore looking to potentially block a deal that Allianz is doing over in Singapore in terms of one of the insurance companies. Seeing a little bit of weakness there, but a couple of decent gainers in the UK. TI Fluid getting a massive increase to a previous takeover offer. It's around 200 pence a share. It closed at 150. This is in the parts space. And also Mulberry Handbags. This is Mike Ashley stepping up his attempt to take over that company via Fraser's Group, upping the bid. Mulberry are considering it. It is down in the small caps now, but it is one that's moving a lot today. Then, in terms of a couple of broker moves we're going to bring you, this is playing into one that Lilia was talking about, your guest just there, around French taxes. We've got Hermes cut to sector performer over at CICC, something we don't see too much of, but remember that stock up around 25% over the past year, one of the best performing luxury firms. Then in terms of energy, Equinor gets an upgrade. Now Morgan Stanley is actually more negative on the space given the decline in oil that we've seen recently, but they like Equinor on valuation, so they upgrade that one. And then finally, this one we mentioned earlier, BASF, the big chemicals company, cut at UBS. They are citing weakening macroeconomy for chemicals companies. Pretty interesting, and that one is slipping 1% in Germany today.
Joe, thank you. Joe Easton from our equities team with an update on some of the stocks that are moving around. And he started off that update talking about the gaming companies, talking about gambling businesses, and they're certainly on the back foot. As I said earlier, another day, another bit of speculation in the media here in the UK about what might be taxed come October the 30th, and that's the reality facing all of these businesses who have assembled to listen to Keir Starmer, the Prime Minister, talk about investing in the UK. Yes, they've got some of the broad strokes, but they don't have the detail around taxation and around a host of other things that they probably want before they make firm plans.
This is the problem. These things are in the wrong order. We don't know. So we don't know two things. We don't know what the taxation story is going to look like, and we don't know what the industrial strategy is going to look like. Two really big pieces in the puzzle to form a decision on whether or not you actually want to invest at the moment. And this is the problem that we have with this investment summit. Basically, Starmer and Reeves are going into it with one hand tied behind their back. Now, they tied it there, but nevertheless, that's what they're going in with.
Well, the mechanism, I think, is interesting here around windfall taxes and broadly, because you see it now. You see it in France. Of course, we've talked about that last week. You see it in Italy around the banking sector and arguably the energy sector as well. Spain has also been a part of that. How effective is it, though, if you're trying to spur innovation, if you're trying to bring the private sector to head up some of this investment summits, investment conversation, and yet, to your point, you're perhaps tying the other hand behind your back as well? Yeah,
and depending what sector you're talking about here, though, sometimes there's another policy push, isn't there? And I imagine with the gambling sector, there's that policy incentive that, perhaps you can exercise some of your other priorities by deciding what you tax, and maybe gaming companies stand out as some turf that they could look at for that purpose if they don't like what they do broadly and the risks to society that go alongside that.
The biggest problem that all of these countries have in Europe right now is growth. So we can tax, we can change kind of small things, we can tinker around the edges. But ultimately, if you want to fund public services at the level you want to fund them, if you want to give unions pay rises at the level you want to give them, if you want to provide defence at the level that society requires, you need growth.
Yes.
And that is where the challenge lies.
And
here.
at least the Prime Minister has talked about that a lot, and lots for Stephanie Flanders to talk to him about then when they sit down and have that conversation later on today. Coming up on the programme, JPMorgan topped third quarter expectations as it kicked off the US bank earnings season. Our preview of what is ahead for the other big US lenders, a lot of them reporting this week. That's up next. This is Bloomberg.
I've been quite clear that I think the future could be quite turbulent. Cash is a very valuable asset sometimes in a turbulent world. And you see my friend Warren Buffett, is stockpiling cash right now. I mean, people should be a little more thoughtful about how we're trying to navigate in this world and grow for the long term for our company. I prefer to wait. We will be able to deploy it. Our shareholders will be very well served by us waiting.
That was, of course, Jamie Dimon, potentially future Treasury Secretary. I joke. Talking about stockpiling cash, talking about his friend Warren Buffett, talking about turbulent times. Dimon also warning that 2025 NII hole will now come in below analyst estimates, while also keeping very much taking aim at questions on the topic.
NII, all things being equal, is a number, but all things are never equal. I think we spend too much time on just this irrelevancy, so you get a model and a number in your model, and so it's going to be less than 87 next year. Probably not a lot. We don't know, and we don't know the environment.
Don't know the environment. Don't know what's going to happen. Let's talk about the numbers. Let's figure out exactly what we're going to learn throughout the rest of the week. Remember, we've got JPMorgan and Wells. We're going to start again tomorrow with the bank earnings because we've got a holiday, in theory, in America today. It is Columbus Day. We've got Citigroup, we've got Goldman Sachs, we've got Morgan Stanley, all coming up later on this week. Let's bring in Bloomberg's Charlie Wells. Let's start off with JPM. Those were solid numbers. Is that a reflection of the US economy and the strength that we're seeing? Is that basically a microcosm of what we're seeing at a macro level?
It's interesting. I mean, Dimon on that call sounded annoyed, and he sounded some signals about geopolitical risk, a couple issues in the economy. But when you turn to the CFO, to Jeremy Barnum, he was a lot more optimistic. He talked about a potential for a soft landing, a no-landing scenario. We heard him talk about the American consumer. Of course, this is why we kind of care about these big U.S. bank earnings. They give us a really good read on where the U.S. consumer is. And he talked about how they're in great shape. And some of the consumption mix is changing a little bit. It's kind of moving beyond that post-pandemic experiences shift and more toward a normal pattern of consumption, but emphasis on normal pattern of consumption.
Charlie, explain to us a little bit more about Dimon's annoyance. Why was he so upset about this focus on net interest income?
He got a lot of questions, to be fair to him, about it.
This was question 10.
This was like question 10 million.
Okay, right,
but
I get that.
That figure is really important, right? It's the largest source of revenue for these banks. It's been so positive for them. I think we spoke one point about how, these banks can thank Powell for the amount of revenue that they were bringing in. Of course, this is the first earnings report post that rate cut, and so there's a lot of concern about it. But look, on Friday, they had some good news. It was actually, they beat expectations. Net interest income was up 3%, but it's all about 2025. And of course, Dimon trying to set expectations there.
Where does Wells Fargo fall in all this? You kind of got the top of the pile and then I don't want to say bottom of the pile, but definitely not the top of the pile. Are they sending the same message?
They had a pretty good Friday as well, and it was a little bit more what you'd expect in this environment. So net interest income was down. They kind of missed expectations, down 11%, but their investment banking fees were up 37%, and that is what Charlie Scharf is really going to want to see. He's been plowing into that unit. He talked about diversification into credit cards, but the one thing, a kind of dark spot in their earnings call, was commercial real estate. We, of course, know their loan book has more commercial exposure than a lot of other banks.
Take Friday into this week. What is the lesson I learned from Friday that I can take into the numbers that we're going to get from the rest of the banks?
The lesson is don't take that cut in September and, smear it across all these earnings quite yet. It's going to be a kind of transition into this lower rate environment. Take what some of those CEOs said last month. We got a lot of warnings from Pinto at JPMorgan. We got warnings from Solomon about trading. I think that's going to be the focus at Goldman. How does their trading revenue come in compared to a really standout quarter in FIC last year? And Bank of America, I mean, let's try to get more of a read on consumer. I think, we heard from Barnum at JPMorgan, great, pretty good standing of the consumer. Does that follow in with Bank of America?
Interesting, though, that the clues so far, if you take Wells and JPMorgan, there weren't any huge red flags, were there, around the consumer? Certainly credit card, that sort of data. Standing up okay, Charlie, is that right?
You saw a lot of resiliency there. And I think one, though, aspect on the consumer that is of concern is the housing market. And Barnum there talking on the earnings call about, the housing market's a little bit stuck right now. And just because we got a slight downtick in Fed rates, that doesn't mean there's going to be this huge refinancing. That doesn't mean that the residential real estate sector suddenly starts to pick up.
Charlie, thank you. Thanks for the update. Bloomberg's Charlie Wells all over the banking sector. We're also watching closely what's happening with the gaming sector this morning. We see the likes of Entain down by 13%. A lot of weakness coming through on the back of that report in the Guardian newspaper on Friday that talked about increasing taxation on this sector as being one of the ways that the Chancellor might be trying to sort of make the numbers add up when it comes to the 30th of October.
Yeah. How do the numbers add up? That is going to be clearly something that we're going to watch out for very, very carefully. Which sectors are going to ultimately be in the firing line? Are we going to see the banks being put under pressure as well? They've had a few meetings at Downing Street. Maybe there's been some pushback on additional taxes for the banking sector. What can we expect out of the oil sector as well? Is that going to be another area that the government has to maybe turn to in order to raise some revenue?
Shall we check the luxury sector as well? Because the CAC 40 is underperforming a little, down by 0.2%, and luxury stocks not doing well today. So despite any recovery that we saw through the Chinese session and, some positivity there, maybe not enough on the consumer side to satisfy European investors and what they want to see from the luxury sector.
Yeah, not to mention that perhaps a little bit of a reaction, given that it is France's biggest sector, to what we heard on Friday. Coming up, of course, we're going to dive into the China story as well. We're going to be hearing from George Magnus from Oxford University's China Center, getting his thoughts on what that weekend stimulus briefing actually looked like. Was it short on specifics, or did we get just enough? Stick with us. This is Bloomberg.
We have expanded the large scale of fiscal expenditure, setting a government deficit of 4.06 trillion yuan for 2024. We have issued 1 trillion yuan of ultra-long special treasury bonds, while making good use of the traditional government bonds issued in 2023. We will increase support for local governments to address debt risk, increase debt quotas on large scale, and support local governments to resolve hidden debts. Therefore, local governments can free up more energy and financial resources to promote development and promote people's livelihood.
Chinese Finance Minister speaking at that briefing on Saturday. China's highly anticipated stimulus message seems to be so far lacking the firepower that investors have been hoping for. Beijing promising more support for the struggling property sector. It's also looking at local governments, but economists aren't yet convinced that this is enough to defeat the deflationary story that we're seeing coming through in the data. Let's bring in George Magnus, Associate at Oxford University's China Center. George, always a pleasure, sir. Nice to see you. What do you make of the efforts thus far from China? Is it enough? Will more be required?
Well, I think, as you said, from a market perspective, the press conference from the Ministry of Finance yesterday was a bit disappointing. I think people were expecting, that there was going to be some flesh on the bones of what had been a story going around about a 2 trillion yuan borrowing program split roughly between, helping out local governments and consumer, I was going to say handouts, but basically child benefits for families with more than one child. Anyway, the bottom line really is that it was a bit disappointing from that point of view because there were no numbers, there were no specific plans. But I suppose, we could hold fire because there's an important meeting at the end of this month, the National People's Congress Standing Committee, which is usually the body that approves specific numbers on borrowing programs. And so people, I think, are still quite hopeful that there will be, more specific numbers on borrowing later this month. The question is, what is it on? Okay. What are they going to use the money for?
Well, what are they going to use the money on? And to a certain extent, is spending money the right solution here? Is China in a liquidity trap? Is that the problem we now find ourselves with? And actually what is required is more structural change, of which there seems to be actually very little in what we've heard thus far, George.
Yeah, so this is the rub. I mean, a lot of what the government has announced so far, which set the market alight in late September for a couple of weeks, really was of the monetary variety, you know, cutting interest rates, cutting down payments on homes, cutting mortgage rates, this 800 billion yuan program for stock buybacks and for allowing non-banks to buy stocks and so on. So this is like Band-Aid, right? It's a relief, brings relief, it makes financial conditions easier, but it doesn't really change anything. The second part of the shoe that everybody's expecting to drop now is the fiscal shoe, which is about bond issuance for purposes of financing consumer demand specifically. Because there are some cases for financial engineering, which is, you know, debt swaps between central and local governments and relieving the bad financial conditions that prevail amongst many local and provincial governments. But that's not going to turn the economy around either. So the problem is twofold, really. One is the government sees China's economic problems as a counter-cyclical problem. They don't see it as a structural problem. And the second problem is that they don't really want to recognize the implications of structural economic reform because they're politically very, very awkward.
Well, George, I want to dive into that structural reform in a second. But before I do, I'd like to go back to the point you made about the stock market reform in particular. Given that China's stock market has kind of over-indexed retail exposure to it, does addressing the issues in the stock market, even as a liquidity kind of influx or as a buyer of last resort, ultimately help the Chinese consumer? Is that a connection we can make?
The short answer to that is no. So most of China's households own their wealth through two mechanisms, really, or two channels. One is property, and the other is low-yielding bank deposits. And of course, the problem with property is that prices are falling, and you know there's not very much confidence in the real estate market, and you know that may be something which will prove very, very elusive. But obviously, you know. We've seen this before, that in 2015, 2016, when the government tried to pump up the stock market to try to engender confidence into financial market participants, which are principally banks and SOEs, not retail. Now they're kind of trying seemingly to do it again. But I don't think this is going to have much of a spillover effect onto the consumer or onto households.
Well, let's go back to the bond issuance story that you mentioned as well. How attractive is that debt? I appreciate that you're more of a professor than an investor, but George, how attractive is that debt, or is the Chinese government even trying to make that debt attractive to international investors? Is that international demand relevant to the China story right now?
Well, I used to be an investor, so so I've got a bit of both. Yeah, I mean, you know, I don't think, obviously, because of the external bonds which have been, you know, which foreigners have been involved in, particularly those involving property developers. I mean, foreigners' experience with China's, you know, bond market hasn't been a happy one necessarily. And actually, the bonds which are going to be issued and which the government will issue approval for local governments to issue aren't really the kinds of instruments that foreigners are that interested in. You know, to be honest, I mean, the issue isn't really a shortage of money. I mean, they can issue, the central government certainly has space on its balance sheet to be able to leverage up and issue more debt, even if local governments are finding this really difficult. So there are ways in which they can issue more money to spend, but come back to the question really is, you know, and they will be bought because domestic investors will buy these bonds even if foreigners don't. But the question really is, what are you going to spend the money on, and how, and who? And that's the issue really, is about, you know, it's about how do you structure an economic a revival program? I mean, a lot of people, I would just say this final point, a lot of people think that China's government is actually not very interested in reviving the economy anyway. All they're interested principally in doing is stabilizing it so that it doesn't go down into a kind of a vortex of deflation. because Xi Jinping's principal priority is what he calls new productive forces, which is really about cutting-edge tech and science.
George, with your investor hat on, your legacy investor hat on, I wonder if I could ask you about the contrast between what you're telling us and some of the words we got from Goldman Sachs, for example. Now, they're speaking mostly about Chinese stocks in this particular quote, but they're saying that there's a powerful and there can be powerful and tradable rallies that can exist even in a prolonged deflationary bear market. So they're sort of talking about the gains that can be found within Chinese stocks, even if some of these structural headwinds do still exist. I suppose both of these things can exist at the same time then.
Yes. In fact, I was the victim of one of them for most of the last year or last few weeks. But actually, anyway, that's just another story really about my personal investment style. But yeah, of course. I mean, if you know how to trade Chinese stocks and you trust, your broker or your investment advisor to be able to get you in and out, easily or without too much trouble, sure, these things happen. We've seen a number of spikes in Chinese equity markets, very kind of staccato type of rallies. But actually, if you look at the kind of big picture, just draw a chart of the CSI 300 or the Shanghai Comp, and you can see 2 or 3 really powerful spikes. But actually, for most of the time, the market trades sideways. It's not really a very active market, I think, for long-term investors. But yeah, I mean, why not? I mean, I don't know whether the market has actually kind of spent most of its kind of force really during the last 2 or 3 weeks. We'll see, but I mean, there may be another leg up in it if there's something later this month.
George, well, something coming up in less than a month is, of course, the US election. What do you see happening in China to prepare for what could be a much higher tariff environment coming from the United States?
Well, to be honest with you, my gut feel is I'm not really sure it's going to make a huge amount of difference, in the sense that Chinese authorities, Chinese government will have had plenty of time to think about, what's likely to happen. I mean, obviously, if Donald Trump, gets to the White House, there's a sort of threat and even a plan to some degree of ubiquitous tariffs, which I think they would expect to retaliate against. If not, then they face an environment of export controls, or sort of a continuation of the Biden administration's different sort of approach. I mean, there could be additional policies introduced to try to target, Chinese goods or Chinese technologies. I think they are well aware that, that there are in this adversarial environment, and they will be, even more determined than ever, I would say, to pursue their policy of self-reliance and to de-Americanize their supply chains as much as possible. I think in that sense, I don't think it really makes much difference who's in the White House, to be honest.
George, thank you. Always great to speak to you. George Magnus, Associate at Oxford University's China Centre. Thank you very much for that. I wonder how many Chinese cars will be on display at the auto show taking place in Paris. We'll be talking cars next. Oliver Crook is with us. He's at the Paris Motor Show. Ollie, what's coming up?
Yeah, that's right, Anna. And actually, you can see a few of them behind me from Leap Motors, which is the joint venture with Stellantis. So we've been here. We talk a lot about the auto industry and the slowdown there. This is really where the rubber hits the road, a chance for these car companies to put their products in front of their clients. We'll have conversations throughout the morning with the key CEOs. This is Bloomberg.
Tesla, the company that led the way in the EV revolution, is taking another leap of faith.
Elon Musk is a master at figuring out where the trends are and marketing to those, and AI is hot right now.
He wants to keep people thinking of Tesla as the company that is pushing the envelope and is really a tech company, not just an automaker.
Most important thing, as he sees it, is the robo-taxi, or what Tesla is calling the cyber cab.
And its gambit targets not only the car industry, but ride-sharing as well.
If I own a Tesla, it can drive me to work. But if I'm on vacation and I want to make money, I can lend my Tesla to this shared autonomous robotaxi fleet.
Though some big kinks need to be worked out first.
The human experience as reflected in driving is more complicated than people like Elon Musk thought.
Watching the event, my first impression was, is this just another Musk rug pull?
He's betting the company on this technology. It's a very, very risky bet.
You can, of course, watch the rest of this week's mini doc about Tesla's robotaxi on our YouTube channel or at Bloomberg.com. Guy.
Okay. Let's talk about what that means, what he's doing, and how it's going to change the landscape for the European car sector, which is facing a number of different crises right now. It's been a brutal year for Europe's car makers. Just take a look at the numbers over the last 6 months. Sales slumping in the face of fierce competition from the Chinese. You've also got a union issue, which you need to factor into your thinking as well. You've got a tax issue. Look at what is happening in Italy. Look at what is happening in France right now. The Paris Auto Show is underway. Let's get a sense of what the vibe looks like, feels like there. Ollie Crook, as we know, is standing by. Ollie, what do the European automakers need to deliver at this show?
Yeah, Guy, listen, you walk around these halls, and this is really the EV car show. And for the European car makers who are facing what we've continuously been talking about, really that perfect storm of lowering demand, particularly in EVs, rising competition, and also these new regulations, Guy, which we don't talk about that often. At the end of this year, basically these European car makers need to sell about 20% of their fleet to be EVs. Otherwise, they could face literally billions of euros worth of fines. It's stuck right now at about 15%. So crucial for those automakers to bring these new sort of EVs to market, and front and center, Guy, is that price point. We know about the tariffs on the Chinese cars. That buys them a little bit of time. They need to be reducing that price point. So they're unveiling cars that are about 35,000 euros, some under 25,000 euros, and longer term, Renault is planning a car for, sub 20,000 euros. That's sort of still a far cry for some of these Chinese automakers like BYD, the Seagull. That retails for less than 10,000 over in China. But this is really the conversation here. And also, how do you adapt that strategy in the face of that sort of lowering demand? These are the kinds of conversations we're going to have with the CEOs here at the Paris Auto Show.
That's the European side of the equation. Talk about the Chinese automakers there as well, facing a very different situation than just a couple months ago.
Yeah, that's right, Kriti. Just a couple of months ago, and 12 months ago, or a little bit over that, when we were at IAA over in Munich, they were so excited. We spoke to BYD, Xiaopeng, all of these automakers that were really very excited to come in and enter the European market. And as you say, from a couple of months ago, the picture has changed completely. You have these tariffs. They're not 100% final yet. There is still some hope from some of these automakers that they could negotiate either a better tariff or maybe some sort of compromise. That seems sort of unlikely right now. But what you have in terms of their broader strategy is it's basically unchanged, because as far as they're concerned, the European market is absolutely key for the EV growth. Obviously, China is enormous, but they really need to break into this wealthy market. The U.S., they can't really touch. They've got about 7% market share right now, and what they're trying to do here, even if they can't make the kind of money that they were hoping to make pre-tariffs, is to build that brand awareness and become sort of more present in the European consciousness, because it's only a couple of years from now when they're going to be producing these cars right here in Europe.
OK, so that's the backstory then, Ollie. We've got a lot of headaches for the automakers, a lot of challenges they face, and competition from China is on the increase. We have a lot of brands here. I'm sure there are a lot of brands on display where you are. Are they all going to survive?
Well, listen, that's the big question, Anna, and I think that we're sort of early in this sort of crisis where we're talking about, can all of these sort of brands really survive? I mean, Stellantis alone has got 15 brands. Volkswagen has got any sort of number of them. And the real question is, for a smaller car maker like, let's say, Renault, for example, can they continue to sort of compete with those massive car makers on their own? So we'll be speaking to the Renault CEO a little bit later. How do you defend over being a potential takeover target when in a sort of very, very crowded room, when you can see sort of behind me all of the brands that are sort of behind us here, and also here, with the Leap Motors, for example, which has got this partnership with Stellantis. How many of these sort of joint ventures are we going to see to be able to split potentially manufacturing capacity in a world of more protectionism?
Thanks, Ollie. Thanks for joining us. Bloomberg's Ollie Crook joining us there from the Paris Auto Show. So we have a lot coming up when it comes to the car sector. Later today, as Oliver was saying, we'll be speaking with the CEOs of Stellantis and Renault, as well as a host of other leading figures from the European auto industry. All of that coming to you from that Paris Motor Show. Here in the UK, as we've been mentioning, the Investment Summit is taking place in London today. Prime Minister Keir Starmer and Chancellor Rachel Reeves hope to be able to announce billions of pounds of major investment deals in AI, in life sciences and in infrastructure during the summit. We're joined by Bloomberg UK correspondent Lizzie Burden, who's got details of what we can expect from the event. So take us through then, Lizzie, good morning, some of the detail of what we're expecting to be announced today.
Well, big picture first. The government's top priority, of course, is to grow the economy, and they say that investment is crucial to that, hence the spotlight being on London. We're expecting Keir Starmer to be surrounded by the global bosses of finance and tech, and to say that he wants to rip out the bureaucracy that blocks investment and do everything in his power to galvanise growth. Now, what does that mean? We're expecting an announcement of £50 billion of private sector investment into the UK economy, but half of that was already announced last week for green infrastructure. We're also expecting an announcement on the industrial strategy to tell us which sectors the government favours. But we're not going to get details on that until next spring. So the ongoing frustration that we have to wait for detail from the Starmer government.
But we still don't know what's in the budget.
Indeed. And there's so much frustration about the choreography of this, that they would put the investment summit before the budget. Why not give us the policies on October the 30th and then tell us the messaging around it at the investment summit, or potentially more detail? That is not what's happening here. And we have worries about potentially employer national insurance contributions going up. This was not denied by the Business Secretary over the weekend, on top of the fears about changes to capital gains. So these very people who Keir Starmer wants to attract, who he'll be surrounded by today, could be packing their bags and out of the UK after October the 30th, if some of the warnings are correct.
So that employment story is significant. So it's interesting. There's a line in the FT this morning, economic uncertainty holding back hiring, says Page Group. This is the problem, that we find ourselves in a situation where we don't know yet some of the major issues that we're dealing with, and as a result, hard to make decisions long-term if you don't short-term know what's going on. Lizzie, thank you very much indeed. Bloomberg's Lizzie Burden. We've got some fantastic interviews coming up as a result of this summit that is taking place. The centrepiece of those interviews, of course, will be with the UK Prime Minister, Keir Starmer. That is going to be taking place a little bit later on today with our head of economics and government, Stephanie Flanders, at the UK International Investment Summit. The interview is taking place at 2:30 p.m. London time. We're also going to be hearing from the CEOs of Barclays, Lloyds Banking Group. They're both exclusive and will be coming up shortly. Kriti.
Certainly something we're looking forward to. Let's talk about what else we've got going on this week. Of course, we were just talking to Oliver Crook live in Paris at the Paris Auto Show, talking about the automakers there. But then we've got our focus on more data, more earnings on both sides of the Atlantic. On Tuesday, the eyes, or I should say the spotlight, back on the banking sector. Goldman Sachs, Citigroup, Bank of America, all reporting on the earnings story as well. Not to mention the slew of data. We started the week with China. We're going to end the week with China as well. Plenty of retail sales on both sides of the Atlantic. But let's talk about the ECB here. That's the decision on Thursday. Lizzie will, of course, be on the ground in Slovenia, I believe, to cover that decision for us. Does it really change the dial now that we've heard some dissent between the Federal Reserve, now that we're talking about the pace of rate cuts? I wonder what the conversation will be.
Yes, and we don't have the expectation that they'll go 50, do we? But you're right that the Fed has sort of broken that taboo if anybody wants to, and we have seen other central banks moving in that kind of increment, so not everybody going 25, but I think the expectation has shifted from nothing to 25 for this month, hasn't it? Just after September, there was no expectation we'd get these back-to-back cuts, but now that seems to be coming.
It's interesting. The Fed made the decision. Powell made the decision, kind of almost unilaterally, it felt, in order to go for the 50. The ECB feels like it's being pushed to make these decisions. It's being pushed by the data, by the economic numbers, by the terrible situation that we're watching develop here in Europe in terms of the slowdown in growth, to make these decisions. Yeah. It feels like the Fed's the master of its own destiny. The ECB feels like it's reactive at this point.
And that's just the monetary side. We're not even talking about the fiscal piece that maybe the monetary may have to react to in a couple of months, especially for the Federal Reserve reacting to the U.S. election results. But even right here, when we talk about in just the last, I want to say 24 hours, but 48 hours, 72 hours, where France did get this kind of outlook downgrade as well. Everyone's on alert for what deficit concerns means for yields, what it means then for monetary policy.
Yeah, and what governments can do to spend in the meantime. We mentioned the UK has made some announcements around spending. We've yet to see the full details of the budget, so we'll keep that one under review. But yes, the market can constantly weighing up then what monetary policy actors are going to be able to do in the context of fiscal constraints, I suppose.
Well, OK, Steve Blitz was here earlier on in the last hour. He was talking about 6% Treasury yields.
Yeah.
If you get 6% Treasury yields, where does that leave Europe? Because there is going to be a gravitational effect. It means that the monetary policy story is going to be blunted. Yes, it probably it would affect the front end less, but nevertheless, the cost of money is going to be higher.
He's talking about a much more inflationary world there, isn't he, than we've known just, post-GFC, before COVID. And a lot of people seem to talk to us about how we are in a different place. Even Jamie Dimon was saying about all these inflationary forces, and yet we still have central banks around the world supposedly targeting 2%. You wonder if we're just going to accept that we're missing those targets more than we used to miss those targets.
And it's fascinating what Steve Blitz said about that 6%, though, and the fact that he said it's if the budget isn't addressed. But let's say, I'm going to play doomsday for a second. Let's say it isn't addressed over in the States, or if you still have these budget deficits in Europe as well. What is the worst-case scenario? In Europe, you see it in bond yields and bond spreads. We've seen that with France and Germany. You see that in terms of the ECB. In the U.S., where else do you go? They don't address it. What happens? Do you then see a bid into the Treasury market, say, the way you did in 2011?
Well, no, I think you see the Treasury market on offer, and that's... You see yields going higher. The term premium required is going to be greater.
Yeah.
You're likely to see a slightly more inflationary environment, but you're going to see the bond market is going to demand more.
Yeah.
What impact is that going to have on growth ultimately, I think, is going to be really interesting.
Yeah. And in the very short term, this week, back to things that we're watching, we'll get the bank earnings story, and that'll give us a clue around the consumer and where that side of things goes. Even if the consumer signals that came from JPMorgan and the rest seem to have been quite positive, we'll see whether Bank of America and the like tell us something similar. That is it for the opening trade. The pulse is up next. We have some big interviews coming, including the CEOs of Barclays and Lloyds Banking Group. All of those conversations coming up shortly from the UK Investment Summit. This is Bloomberg.